We always talk about debasement from a debt perspective. The debt of the US government at $40 trillion is small in comparison to the household net worth in the United States of $175 trillion. The global assets are $800 trillion. Most of that is illiquid. The liquid part, the stocks, the bonds, okay, they're both down this month. This will be the worst month for a 60-40 portfolio since 2022. That includes Liberation Month last year. So that's because it didn't stay down that long. This will be a bad month for people in their portfolios. What are they going to do? What are they going to look to? Well, Bitcoin during the month is going to hang in there. And if all of a sudden you look back at the end of the year, and this is the reason why, I think there's going to be a flood of money into liquid items that are growth.
The global financial system is being forced into a position it hasn't faced in years. And this time, it's not just about interest rates or monetary policy. It's about geopolitics colliding with fragile markets. The escalating US-Iran conflict has triggered a full-scale oil shock, sending crude prices surging past $100 and reigniting inflation fears across the global economy. And just like that, the narrative has shifted from soft landing optimism to a much harsher reality. This isn't just a temporary disruption, it's a repricing of risk across the entire system. When oil spikes this aggressively, it doesn't just impact fuel costs. It hits transportation, manufacturing, food, and ultimately, economic growth itself. The longer this conflict drags on, the more it begins to resemble a stagflationary environment, where growth slows, but inflation refuses to come down. This is the exact argument Jordi Visser makes in his latest discussion with Anthony Pompliano. While most investors are still hoping for a quick reversal, another short-lived panic followed by a recovery, Visser argues that what we're witnessing is something far deeper, a structural shift in how markets behave under stress, and more importantly, where capital flows next. And as you'll see in this video, Visser doesn't just outline the risks, he makes a bold and, frankly, astonishing prediction about where Bitcoin fits into all of this. If you're trying to understand what comes next for the markets, you'll want to hear this. So make sure you watch till the end. And if you find value in breakdowns like this, don't forget to like the video and subscribe, because what's unfolding right now is moving fast. Thanks, and enjoy the video. Buy $10,000 of Bitcoin on a regular exchange. It grows to $60,000. That $50,000 profit? You could owe $10,000 or more in capital gains tax. Now do the same trade inside a Roth IRA with iTrustCapital. That growth? Tax-free. You keep the full $50,000. Same crypto. Completely different outcome. iTrustCapital lets you hold crypto in a self-directed IRA, trade 24/7, and secure your assets with institutional-grade custody. You can also hold gold, silver, and stake certain assets. Real U.S. customer support. $100 bonus when you fund through the link below. In crypto, structure beats timing. Every time.
For the last 3 weeks, I think there was hope that this was going to be a repeat of last year. So let's use something people are all very familiar with. Let's assume you get the stomach bug. You throw up all night, but then the next day, it's over. Well, that was Liberation Day. That was the tariffs.
This too shall pass.
It was just gone, and then you move on. Then there's the other one, which is just a cold that you can't get rid of. And 3 weeks later, it's still there. Submission is coming to the reality that you don't know when this is going to end, but you know something has changed. And for me, I live in a world, and the market does too. It doesn't get recognized this way. And for people that are watching that are just at home investors, when you hear the word regime shift, that is a structural change in a complex system. The market is a complex system. It involves credit. It involves interest rates. It involves inflation. It involves economic growth, stagflation, productivity, whatever you want. I think for the first time, institutions in this last week have finally come to the conclusion, and maybe it's because I've been negative now for a period of time and just saying, I think this is going to be a very challenging year. And in particular, I think it's going to be a very difficult year for covariance matrix, the relationships that have existed for a long time between bonds and stocks, bonds and inflation, inflation and oil, and all these different things. Well, we're at that point now where the damage is going on. And at some point, and I wrote a paper on this for 22V, that when in the first Rocky, he's the underdog, but then he knocks out Apollo Creed in the first round. He didn't win the fight, but that set that it was going to be a long fight. And I think that's what submission is. I think this was the week that people realized that this isn't going away like it did last year in two parts. One is, again, the market's not throwing up. It's just kind of going through this deleveraging phase where everyone's raising cash, but they're getting rid of their market neutral positions and they're gradually taking things down. And two, this isn't going away quickly in terms of oil prices. This will be the fourth week in a row where we're closing above $90 and everyone's done with taco. Everyone's had enough of, they know the drill. Friday, I threatened to do X. Monday comes before the open. You know what? We're going to extend it for 5 days. We're going to extend it for 2 weeks. I think people now are focused on the probabilities of boots on the ground and the probabilities of when is the straight going to open. And none of those at this point are looking like good outcomes.
Based on prediction markets, boots on the ground, 70% odds by the end of April, give or take.
Yep.
The straight being open, 30% odds by the end of April. What do those two numbers tell you?
Well, the straight is the realization from people that they've now done their homework and they realize that even if magically it was open, it's still going to take a long time to get back to where it was, where it could considered to be truly open. It just means that the shortages that we're starting to see around the world, they're going to be here. And these are real shortages. This is COVID-like problems. And I think this is the scarier thing to me is most people knew us because they don't feel it and they don't see it. I mean, they're out of diesel and gas in places like Australia and places like New Zealand. Now, not completely, but there's websites that show how many days left of inventory they have. When China put up the ban on exports of refined products, this was weeks ago. That was a warning sign, and everyone inside the energy market knew that, oh my gosh, I mean, the Chinese have their own intel, and they're saying we're not exporting anything anymore. We're hunkering down to take care of our own country. Plastic, polyethylene, through the roof, hasn't come back down. Jet fuel prices, massive. You're starting to see airlines raise prices. In the US, they're only talking 20%. In Asia, Cathay Pacific last night, 37%. Like the inflation thing is real because the shortages are going to take some time to get through. And it isn't just the straight. There was a lot of damage done to the infrastructure, particularly things that, like I mentioned last week, with Vaslafan in Qatar. This has implications for LNG, but it also has implications for helium. And so helium, there's enough inventory for semiconductors in Asia, but that's starting to get more alarming. And you're starting to get examples of something Jeff Curry said on all of his interviews, which is when countries start worrying about their own situation, and this is what happened during COVID with the masks, they start hoarding things. They start building inventory because even if the strait were to open, what's to say there won't be a drone that hits a tank if all of a sudden tanker, if something goes backwards. And we've learned now that the strait shuts down if one thing happens. Nobody's going through there if all of a sudden hostilities start to increase again. So I think there's a very, very difficult situation that the market's coming to terms with, that this is more structural than they thought.
What Jordi Visser is describing here is a shift in market behavior that most investors don't immediately recognize. In past crises, the playbook was simple: panic, policy response, recovery. But this time, the reaction is slower, more drawn out. Liquidity isn't rushing back in. Instead, capital is quietly pulling out, repositioning, and waiting. And it signals something much more persistent beneath the surface. At the same time, the inflation shock driven by energy and supply disruptions is starting to collide with weakening growth expectations. That combination forces institutions into a corner. They can't rely on the same hedges, the same correlations, or even the same assumptions that worked for decades. And as this regime shift takes hold, Visser believes capital won't just sit on the sidelines. It will move. The real question is where it goes next, and why he believes Bitcoin stands at the center of that shift.
Bitcoin?
That will be at all-time highs.
All-time highs by midterms.
Yes. In my opinion, Bitcoin will bottom first. It's already acting better. I mean, it's amazing that during this whole 4-week period,
crazy
4 weeks, it has sat every single day between 68,000 and 72 on a closing basis, except for like 3 days. It's insane that you've been able, it's sit there. Now,
Why do you think that's happening? Just before you get to the price.
well, first of all, I do think that there were a lot of trades that were short Bitcoin in general. So one of the things people have to do, like I was listening to some podcasts on the way over here, like, yeah, consumer staples are going down. That means something good's happening in the market. And I'm like, guys, you guys got to get used to this. When there's deleveraging, pair trades are coming off. Deleveraging by definition in the hedge fund world means, okay, I'm long gold, I'm short Bitcoin. I think a lot of people had that trade on. It was working great. Well, when they take that off, it leads to a bid in Bitcoin. The same thing that was killing it. The other thing is software has bottomed. Like it hasn't fallen yet. It's not rallying, but it's not falling. If software has found a level, which I kind of think it has, where it's very difficult for it to go down a lot. So now it just trades with the beta of the S&P. Well, that's good for Bitcoin. So I think that's the first thing that's happened. The second thing, and this is the point that I really do think people need to put in the context, I think we're in a world of liquidity. I think real-time liquidity is becoming very, very important to people. It's not just private credit that people are trapped in. Remember, they're trapped in private equity, like the endowments. They need liquidity. Liquidity is going to be a bigger story because part of the thing that I talk about is I believe the fiat assets have peaked. So the reason I don't think stocks are going back to all-time highs is because I think in 10 years, best case scenario, they're the same price they are now. That's in my mind what I believe because of AI. If that's the case, there's a gradual debasement. And what people have to be comfortable with is we always talk about debasement from a debt perspective. The debt of the US government at $40 trillion is small in comparison to the household net worth in the United States of 175 trillion. The global assets are $800 trillion. Most of that is illiquid. The liquid part, the stocks, the bonds, okay, they're both down this month. This will be the worst month for a 60-40 portfolio since 2022. That includes Liberation month last year. So that's because it didn't stay down that long. This will be a bad month for people in their portfolios. What are they going to do? What are they going to look to? Well, Bitcoin during the month is going to hang in there. And if all of a sudden you look back at the end of the year, and this is the reason why, I think there's going to be a flood of money into liquid items that are growth. And if you want to perform and you're a pension fund or an endowment, they need to make money. Like, I don't think people realize, and having been both at Morgan Stanley and then at a hedge fund where I talk to these investors, they have to meet their liabilities. This is not like, that's why the endowments needed to raise cash. They needed liquidity. So I think the liquidity part of the argument is becoming a story that is very, very important. And the same thing goes for hedge funds. If they're levered significantly and the correlations are shaking, they need to raise cash. They need more liquidity. So I just think there's a problem in the market that people don't realize how much liquidity is going to be in demand for the rest of this year. And that liquidity will lead to items that trade 24/7, that are liquid and have a growth component. So once the equity market finds a level where the multiples are just too cheap, which I think is going to come up within the next 10% of the S&P, I think Bitcoin will again be the fastest horse of the race. And I think at that point, it's going to bring a lot of new people into it.
What about the altcoins?
The altcoins are going to take more time. So, but again, they'll bottom the same time.
Will the altcoins recover to all-time highs?
Some of them will, of course. Don't get me. I love the entire community. I don't want to talk about altcoins. What I want to talk about,
ladies and gentlemen, that might be your answer right there.
I
think they're going to have a very tough time. Sure, maybe there's an outlier here or there. I do not think most of the altcoins are going back to all-time highs. They will bleed out definitely against Bitcoin, and I think that most of them are going to have a tough time.
2027 is going to be a very different year for the crypto space than this year. This year is a transition year away from fiat assets, and for that to work, two themes need to happen. Number one, the growth asset story. And again, as someone who admits repeatedly on every interview I do, I did not expect Bitcoin to come back below 100,000. But I also did not expect the re-rating in software to go so violently so fast because of AI progress. Stable coins traded record volume in January. I haven't seen the February numbers. I don't know if you have, but $11 trillion in the first month of the year off of 33 trillion means the agentic world is accelerating. So the network effects are going to happen. Ethereum is going to benefit from that. Bitcoin will benefit from it. So the most important thing to me is, what are the volumes doing in stablecoins? That's my direct link to the AI agents. how much of the guardrail is being used. Number two, Ethereum is an important gateway for all of the hedge fund people and all of the endowments and all that. And the reason is because it actually can be used in a discounted cash flow. You can actually attach something to it to convert Ethereum back into this. And if people haven't done the work, and I'm sure they have because of Circle to some degree, I am getting asked the question more and more from smart people because I think they're giving up on software. I think they're really getting tired of like, why am I trying to buy this if I don't know? Let me find something that's growing. Well, this area is growing. So I think Ethereum is a critical thing. You need to stay above 2,000. We break back below, Bitcoin will go back down towards 60. But I think this bottoming process is healthy from that perspective. And then the final part is people still ask me the question, well, how does Bitcoin benefit? And I just say the same thing. Do you guys realize that the majority of people do not invest in individual securities with stories? Yes, they do. No, they don't. They're in SPY. There's no story for SPY. Bitcoin is SPY with inside the digital world. It always will be. So when people say store of value, I always sit there. I'm like, do you think a pension fund is ever going to go buy Solana? Do you think a pension fund is ever going to go buy any other altcoin that you want to name right now? Maybe down the road, but they barely got approval to get into Bitcoin. And if Bitcoin's working, they all can buy it at this point for a variety of reasons. And so I think you're going to see weightings in this go up. And if there's one really positive sign, having attended so many events, your events, the Digital Asset Summit this week, the community's not very optimistic from the retail side. From the entrepreneur side, there's a lot of buzz still going on.
What makes Visser's outlook so compelling is that it doesn't rely on short-term price action. It's rooted in how capital behaves during structural change. When traditional assets begin to lose their reliability, when stocks fall, bonds fail to hedge, and inflation remains persistent, investors are forced to rethink the entire framework. And historically, that's when entirely new leadership emerges in the market. In this case, Visser is pointing to a transition away from fiat-driven systems toward assets that can actually absorb global liquidity flows. Not just speculative assets, but scalable, liquid, and institutionally accessible ones. And that's where Bitcoin's role becomes critical, not as a fringe asset, but as what he describes as the index of the digital economy, a benchmark that large pools of capital can allocate to without needing a narrative. At the same time, his warning on altcoins adds another layer to this story. If capital becomes more selective, and if institutions dominate the next phase of this cycle, then not everything rises together. Liquidity concentrates. Strong assets get stronger, while weaker ones fade. And that's a reality many retail investors aren't fully prepared for yet. But the bigger picture here is this. We are no longer in the same market environment that drove the last cycle. The combination of geopolitical instability, persistent inflation, and shifting liquidity dynamics is creating a very different foundation for what comes next. And if Visser is right, the next major move in Bitcoin won't just be another rally, it will be driven by a fundamental reallocation of global capital. If you found this breakdown valuable, take a second to like the video. It really helps more people see this kind of analysis. Subscribe if you haven't already. Thanks for watching and see you in the next one.